Renewable and convertible term insurance provisions are essential components of the national portion of the life insurance exam because they define how a policyholder maintains coverage as their circumstances change. Renewable term insurance grants the policy owner the specific right to extend their coverage at the end of a term period without having to provide any evidence of insurability. This means the insurance company cannot require a medical exam or ask health questions to continue the policy. For the exam, you must understand that even if an insured person becomes terminally ill during the initial term, the insurer is contractually obligated to renew the policy if the owner chooses to do so. A common trap on the test involves the cost of this renewal. While the right to renew is guaranteed, the premium will almost always increase. This is because the new premium is calculated based on the insured's attained age, which is their age at the time of renewal. Test questions often ask why a premium jumped after a 5-year term expired, and the answer is that the risk of death is statistically higher as the insured grows older. Convertible term insurance provides a different type of flexibility by allowing the policy owner to change their temporary term coverage into a permanent policy, such as whole life, without undergoing medical underwriting. This is a vital provision for individuals who initially bought term insurance for its affordability, but later decide they want the lifelong protection and cash value accumulation of a permanent policy. The exam will frequently test your knowledge of how the premiums for the new permanent policy are determined. There are 2 primary methods used for this calculation. The first is the attained age method, where the premium for the new whole life policy is based on how old the insured is at the point of conversion. This is the most common approach. The second method is the original age method, where the premium is based on the age the insured was when they first purchased the original term policy. If the original age method is used, the policy owner usually has to pay a significant lump sum to the insurer to account for the cash value that should have been building up since the beginning. One of the most frequent trick questions on the exam involves the face amount of the policy during these transitions. You must remember that a policy owner can typically renew or convert for an amount equal to or less than the original death benefit, but they cannot increase the coverage amount without providing new evidence of insurability. If a question asks if a person can double their death benefit during a conversion without a medical exam, the answer is no. To keep these concepts straight, remember the phrase, renew or convert, no medical alert. This reminds you that proof of insurability is waived for both actions. When you see a scenario where an insured person loses their health but needs to keep their insurance, these provisions are the answer. Focus on the distinction that renewable term keeps the same type of policy but at a higher cost, while convertible term changes the type of policy entirely. Mastering the relationship between attained age and premium increases will ensure you can navigate the math and logic questions associated with these life insurance provisions. On the exam, always look for the word attained when asked about the basis for renewal premiums and ensure you do not confuse it with the original age unless the question specifically mentions a retroactive premium adjustment. These features protect the insurability of the client and are fundamental to understanding how term insurance serves as a flexible financial tool.